At their core, tariffs are just taxes, essentially a toll on goods entering the country. When a product crosses the border, the government charges a fee, and someone has to absorb that added cost. Those costs can feed into higher prices for goods and services, which in theory can slow down demand and weigh on the economy. But the full effects of tariffs don't hit all at once. According to Goldman Sachs, about 64% of the new tariff costs until June 2025 have been absorbed by US businesses rather than passed on to consumers. Yes, in the first few months after tariffs are put in place, importers typically absorb most of the added costs. Existing contracts and stockpiled inventory help cushion the impact, and that's exactly what we've seen so far. We can see evidence of the stockpiling behavior in the US import data, which shows a sharp spike in the first quarter of this year. Many companies front-loaded their imports in anticipation of tariffs, bringing in far more goods than they immediately needed. This has allowed them to keep selling at pre-tariff prices, effectively delaying the hit and keeping the initial inflation impact muted. So that means corporate profit margins remained strong in the second quarter of 2025 despite the new tariffs. In fact, S&P 500 profit margins just climbed to 12.8%, their highest level since 2021. At the same time, overall earnings for S&P 500 companies hit new record highs, becoming one of the biggest drivers behind the market's recent rally to all-time highs. But these buffers might not last forever. The stockpiles will eventually run out, and the true cost of tariffs could start showing up on the company's results. In fact, economists have found that tariffs' impact on inflation typically peaks about a year after they're introduced. As those early stockpiles are depleted, companies start facing higher costs on new shipments. To protect their profit margins, companies may begin raising prices for consumers, which can feed directly into higher inflation. Smaller firms without pricing power get hit the hardest. Their margins get squeezed, and they often respond by cutting jobs, slowing wage growth, or scaling back investment. This is where the economy could begin to feel the full weight of the tariffs. According to these economists, we could see tariffs potentially get passed through supply chains. Prices gradually rise, especially for everyday goods and services, and that starts pushing CPI inflation higher. As inflation climbs, households' purchasing power erodes and demand begins to cool. Corporate profit margins start to roll over, and companies slow down their hiring to protect costs. The result could be downward pressure on stock prices and perhaps even early stages of a recession.